This is Scott Becker with the Becker Private Equity Podcast. Thrilled today to visit with Matt Wolf. Matt's a brilliant leader at RSM, which is a leader in the middle market and larger market today, private equity world. One of the things that's going on right now is there's so much anecdotal discussion about deal flow, what's going on, what'll go on with interest rates, will it get better or worse? The stock market's obviously up. And other things are going fine, deal flow. Matt's going to tell us what's really happening behind the anecdotes. Matt, take a second and introduce yourself, and then let's talk about what the stats are actually showing on deal flow.
Yeah, thanks, Scott. Matt Wolf. I'm a leader in RSM's private equity practice. Been at RSM now for going on 15 years, had a career prior to that, and been just really focused on deal flow, the deal environment, advising our clients through that. And it's just been, as we close out March, I've been looking at some of the data, right, as we're all kind of talking about, okay, is the deal flow returning? When is it coming back? What is it going to look like? And we'll see when the final numbers come. As we record this, we still have a few days left in March, and we'll get some announcements after the fact that'll be post-dated and things like that. But it's still off to a slow start, at least in terms of completed deals. And you and I have talked about how fewer deals are getting completed, more deals are getting looked at. So it will likely close out at kind of a weak quarter, probably around maybe 1,200 deals total in U.S. private equity-backed deal flow. If you count in, add-ons, recapitalizations, we like to take a pretty high-level look, at least for the first cut of data. That'll be down from about 1,500 or so the year before. Certainly 2022, we were at 1,900 deals for the first quarter of the year, again, sort of broadly defined in U.S. private equity. It's not quite the cataclysm that a lot of people make it out to be. Again, because people are still looking at deals. We're just spending more time on it, right? There's more spent on due diligence. I guess one other quick note, we look at the capital invested too. Capital invested for the first quarter of this year is going to round out at about, it should come in a little bit above $80 billion as we backdate some of the announcements we'll get over the next couple of weeks, which is actually fairly consistent with the $80 billion we had in the first quarter of 23. However, that's really been driven by a couple of large private equity deals in the financial services sector. There have been a few large, $12, $19 billion deals that is skewing that a little bit, and we'll probably see more of that, right? We're going to see as capital increases, we're going to see people taking swings at bigger deals where they can cost of capital increases, see swings at bigger deals where sponsors can have more effect on increasing enterprise value. So that's about where we're at today, Scott.
No, it just is fantastic, Matt. So at the end of the deal numbers are down some, not that cataclysmic, but they've also been helped by a couple huge deals that might skew the numbers.
Yes, yeah, absolutely. In terms of the capital invested, so that's great, right? Looking at the past 3 months, it's kind of helpful to get a barometer of where we are compared to the past couple of years. But looking forward, we're still expecting some level of rate cuts, right? There's been some commentary from Fed officials that maybe it'll be delayed, and we see sort of money market and other sort of smart money positioning for perhaps later and later cuts. We're still on the board for June. For the first cut in June, I think another really positive sign is we've seen some high-profile IPOs. We've seen, I wouldn't say the IPO window is opened again, but it is opening, and that's often an early sign of middle market private equity deal flow, right? As that returns broadly, you look at things, broad IPO market, kind of excluding life sciences, which is sort of its own IPO market. It can tend to recovery in that part of the IPO market, the sort of broad ex life sciences part of the market, can can be a useful sort of leading indicator of middle market deal flow. And so we're still optimistic. It'll be interesting to see when we have this kind of conversation 3 months from now, how did the first half of 24 compare to the first half of the prior few years. But right now, still optimistic. And I think going forward, though, even as people get busier and busier with deals again, I don't expect a return to the deal count that we had before, just because I think that sponsors are going to have to look at many, many more deals before making their investment decisions, and the checks that they're going to write are going to be bigger, right? So we're going to see more scrutiny over fewer deals with probably similar levels of capital put to play, probably even more capital put into play.
Your point on the IPO market is so underratedly important. And the reason why it's underratedly important, there's two things that companies are trying to do, or investors are trying to do. Of course, they're trying to grow cash flow in successful companies, but they're also trying to look at, are there windows and exits, and if they build something or make some investment, they'll have an exit on the other side of it. And your point on the IPO market opening is a signal to investors that there's upside. And that's a very important signal as people put risk capital to work and they take on debt to do it. So I think your point on it is underratedly a really important point, quite frankly.
Well, thanks, Scott. I appreciate that. And it's just really interesting. Obviously, it's much harder to do than to simply talk about. But the IPO exits for a sponsor, I mean, the stock market values such a longer forecast of cash flows than we do sort of in the private markets. And to get that bump, if you can successfully go public, is so huge and so meaningful that simply the allure of it being a possibility, that IPO possibility in a deal model going from 0% to 5% or 10% chance of IPO can really change the economics of an investment thesis. And we do expect it'll encourage more active deal making, particularly in certain sectors.
I think that's, I think that's exactly right. But you're right. It's not that the IPO exit is the exit of choice. It's more that it's directional and a signal that there's opportunities out there for exits and upside. And that gets people excited about investing to see, like, okay, we can invest now, try and improve the company, try and do some bolt-ons. In 3 to 5 years from now, there's likely to be some exit potentials. That's what I think it means. It's not so much that it'll be the actual exit. You're exactly right, but it sure is directionally helpful.
Absolutely. And yeah, I mean, it's definitely an interesting time to watch, especially, and we get into sort of springtime and rates going down, IPO market coming back, companies getting out there, conference circuits and people networking again. It'll be really interesting. I mean, I think maybe frankly, a little disappointed with the Q1 numbers. If I'm thinking back to where my forecast was 3 months ago, but reasons to be optimistic going forward, right? Especially as we get more clarity into the future of the forward curve and the rate environment.
Fantastic. Matt, anything else you wanted to touch on today, and any more discussion there about the rate environment and what to expect?
I don't know too much more about the rate environment. There's a lot we could say, right? We could talk about it probably for hours. The other sort of unrelated piece that we've been talking with a lot of clients about is, the GDP or economic inflationary impact of the tragic bridge collapse in Maryland. And there's a lot going on in the financial press. You can read about people saying how, this is going to be inflationary and supply chains are disrupted, all of this horrible thing over and above the tragic loss of human life. And I would just say what we're telling with clients and sharing, really anybody who will listen, is that, it's obviously a human tragedy. There will be some isolated disruptions, but from an inflationary perspective, from a GDP growth perspective, it's really not going to have an impact. So please don't give too much heed to all of the pundits that are on financial news shows talking about how this is going to be inflationary and disrupt GDP and supply chains. And the doomsayers, I think, are wrong on this one.
I think you're absolutely right about that. I do think the other issue, though, that is an incredible issue that's got to be discussed more, is this concept that we're deficit spending at 7 to 8% of the GDP, and GDP is going up at 3%, or 3.5%. And those are not sustainable numbers. That delta is not a sustainable number. The discussion for a different time, and I know it's a complicated discussion, but it's a simple discussion too. When you're doing deficit spending at 7-8%, and you have in contrast actual growth at 3% or so, that is no good, or as we say, no bueno, which means no good. Matt, I want to thank you as always for joining us on the Becker Private Equity Podcast. Always a pleasure. Thank you very much for joining us. And thank you to our wonderful producer, Chanel Bunger. Thank you, Matt, very much.
Thank you, Scott.